Good morning, good evening, good afternoon, whatever time it is, wherever you are right now. And welcome to another session of Bizar Financing, how to start, buy, or build that business and do it with little or none of your own cash. I'm Gordon Bizar, and I'd like to start out today by wishing you a happy new year. We're going to cover a very special topic today. And the topic is the Buildup Buy-In, which you all know about, but we've elevated it to a higher level. We're using it a lot now. Interestingly enough, the most success we've had with it in the times that since we've altered it is in foreign countries. So I'll introduce you to that and explain why that's such an important aspect of how we were able to create some changes in this that have been very successful. But basically, it's all about partnering to create greater value on sale. Now think about this, okay? Just for a moment. You got all these boomers out there who it's time to sell their companies. The companies are not at the values that they need to retire on and maintain their lifestyle. And so they're caught between literally a rock and a hard place. If they sell the business for the value it is right now, their retirement is questionable. In other words, it's either they're not going to have the level of financial security that they've been seeking, or they certainly are not going to be able to maintain the lifestyle that they did when their business was just generally producing income for them. They're stuck and they're looking for a solution, but they can't do it by selling the business the way it is. So what we've done is we've literally perfected the answer for them. And I'm going to take you through a presentation that we actually constructed. This one was for a company that's overseas. It's in South America. And I'm going to take you through it pretty much the way we presented it to them so that you can see how we're now able to position and frame the Buildup Buy-In so that it's a perfect solution for the kind of things that I'm discussing with you right now. Without any further ado, let's just move on to it and we'll get into this. Of course, there's the question and comment reality of where we are as a live event here. So please type your questions and comments into the question box on the right side panel as you happen to think about them, because that way when I get there, those questions will already be there. Or you can raise your hand if you want to ask your question or comment live. And of course, any unanswered questions, just send me an email at question@bizarfinancing.com and I'll get you that answer. All right, so here's the presentation, just pretty much the way we gave it to them. The only difference was instead of Bizar Financing up in the corner, we had National Diversified Funding Corporation's logo up in the corner. And our conversation with them took place literally as National Diversified Funding Corporation. But the way we framed and positioned the Build-Up Buy-In is this was a way that we could work with them as National Diversified. So if you're doing this on your own, you would just make your own logo, your own company, and that's what would go up in the upper corner up there. But this is basically what you would be conveying to the potential company that you wanted to buy. Anyway, we talked about our Build-Up Buy-In and the idea that we would be partnering with them to create greater value on sale. So that already pretty much has the interest of somebody who's in that position that I just covered with you a moment ago, where they can't get what they need out of their company. And so I would then explain that our mutual goals that we're going to have as we work together is to transform a business valued at $750,000 to $5 million cash to owner within 60 months. Now, that's a pretty good stretch. And by the way, that was the value of the company that we looked at. Now, when the owner of that company was trying to evaluate their business, they felt it was worth $1.5 million to $2 million. We went through with them a valuation process to show them why the company was only worth $750,000, but not to worry about that, because the fact that it's its value now isn't going to matter to us, because what we're going to do is work together with them to transform that business into a $5 million cash to owner sale of that company within 60 months. All right. So now we've set the stage for their expectation of now what can we do for them through this Build-Up Buy-In process. We're going to do it with little or no risk to the owners, and we're going to do it consistent with your culture, traditions, and personal and family values. Now, that's especially important when you do this in a foreign country, because everybody's worried you don't understand our culture, you don't understand our people, you don't understand the values that we have here. They're different than what you have in America. It's really important to, again, frame it in the beginning when you're talking to owners in a foreign country, that you're already taking that all into account, that you're taking the measures to make sure you can do this consistent with who they are as persons and who they are as a people. Now, I don't want you to underestimate that framing there on number 3, even in this country, because people in New York have different traditions, different culture, different personal and family values than people do in Iowa. Okay, New York and Iowa are almost opposite ends of the planet. And except for the fact that we mostly all speak English, there's really a world of difference between the way people see things, the way they respond to certain ways of talking. This is very different. Whether you're doing it here in the United States or whether you're doing this here in a foreign country, these are the 3 things that you want to be able to set out, that those are the mutual goals, the things that we're all going to work to do together. Then we talk about what's the buildup? What does we mean by the buildup? We're going to make an investment in the company, but the investment is not going to be in cash. Okay, we are going to create results for the company that will be measurable. And so our first investment in the company is we're going to add new sales. We're going to add new income sources to them. We're going to reduce their costs of doing business. We're going to improve their cash flow. We're going to scale their business for growth. And that means putting in standards, processes, procedures, records, technology, automation that will be replicatable and be authenticatable, so that when we finish with our buildup, their company will be positioned for a high sale price. Now, the business for growth, believe it or not, is the most important one on there, because when we go back to that $750,000 valued company, guess what they didn't have? Okay, they were a mama papa business. Basically, they had some employees, they had a decent amount of revenue, but at the end of the day, they didn't have a business that could be scaled for growth. Everything was in the head of the owner and perhaps his family members and perhaps another key person that he had. But if you wanted to bring on new people and grow his company, you couldn't do it because they didn't have the platform for growth. So when we come into this business, that's what we're going to be added. Now, you know how we're going to do that, right? Through Scaleforce, okay? That's all automated. We know how to do it. They can go in really quickly to that business. We can train them how to come in and out of the system. We can work with them to set up those standards, the processes, procedures, and the records, and we bring them the technology and the automation that lets them do it. And when we're finished with it, it's replicatable, and everything that they're now doing in that business can be authenticated. Now, why is that important? Well, that's important because if you're going to finance the transaction at some point of actually buying out the full business, you're going to have to do that with lended money or with investor money. And no one is going to loan or invest in that company unless you've got authentic records, unless you've got auditable records, unless you've got records that everyone has faith in, that they really reflect the true state of that business. So even though we'll have done all these other things up the top, the adding new sales, the adding new income sources, reducing their costs, improving their cash flow, all those things really require a scalable platform in order for us to do them. Otherwise, the business is just going to be owner operated. It's going to fly by the seat of its pants, and it's not going to get to any form of growth. They're going to plateau out, if not right at 750,000 of value. Maybe they'll get to $1 million, but they're not going anyplace big until they've done this. So our first investment in the company is not to put in cash because they're not worthy of cash yet. Because anybody putting in cash has to have a way of keeping track of everything, or their cash is going to go bye-bye. All right? So that's our first investment. So they get it that we're going to shape their company into a platform now worthy of a cash purchase price high, worthy of investors, worthy of lenders. All right, so that's the first step. Now, what that does is going to be to increase its equity valuation when you've done those things, and you're now building up that company, and you can replicate it in everything that you're doing. And then we talk a little bit about percentage versus value. So in order for us to do these things, we're not going to take cash from you to do them. What we're going to do is we're going to invest in your company the resources that get that done. And what's going to happen is as those things are achieved, we're going to get equity position in the company. Their percentage of ownership is going to go down because we're starting to earn in a percentage of that company. But what's going to happen is the value of the lesser percentage is going to be higher than 100% of what they had before. So every time we're earning equity, it's because we've made the valuation bigger, and the valuation being bigger means their lower percentage has a much higher value. And then now we're going to show that to them. We're going to show them exactly how we're going to do that and how we're going to do it where it's no risk to them. Okay. And I want to always remind them that we're going to do all this and yet be consistent with their culture, traditions, and personal and family values. Then I go into the explanation of milestones. Okay. In order to do this, and so that we all know what we've achieved together, and we all have a way of valuing the percentage of equity that we're receiving in the company. Okay. We're going to use a system of milestones to accomplish that, to track it. And then the thing we want to assure them is that no shares of their business are going to get transferred to us unless the milestones are achieved. So it's only when the milestone is achieved that's made the business worth more than that agreed milestone. When it's achieved, that's what frees up stock to be issued to us. So our shares are only received when we achieve results. Now, I want to, before I get into this, I also want to make the differentiation between, let's say they found somebody who would invest in their company, even though they don't have records, even though they don't have good records or any of that stuff, right? They found somebody who would do it. They're not going to do it without getting shares in the company, right? If they're going to invest. So they take on tremendous risk at that point, because what happens is they get the money, they give up the shares. So now they own 75% of their business. Let's just make up that number, 75% of their business, and the investor owns 25%. But now let's say that they're not successful doing what they wanted to do with the money. They've given up 25% of their business and they have nothing for it, right? So they own 75% of the same value that it was before, and that's less value to them than when they gave up the shares, right? So they lost by doing it that way if they're not able to accomplish the goal. On the other hand, with us, if we don't accomplish the goal, they haven't given up anything. Working with us is better than an investment of cash, because with an investment of cash, they take the risk that they can actually accomplish something with the cash. With us, we in effect guarantee the results or we don't get anything. So they're ahead. So that's the first thing I want to make sure that they understand is this is better than cash. This is buying results, not cash. You don't know results, they don't give up anything. So once they get that, they're very excited about the possibilities here and they want to know more. So that's an important thing. No shares are transferred unless milestones are achieved. All right, then we go through a little analysis here and demonstration of what this means to them. And just so everybody can follow along with me here, the way milestones work is you establish a baseline, okay, a baseline. And the baseline is what things are now. So let's say that we look at that company and it has EBITDA, earnings before interest, taxes, depreciation, and amortization. So this is the amount of cash flow coming into the business. So you got 187,500. And let's say that the price earnings multiple, based on the fact that, remember, the company doesn't have all this, right? So it's a very low multiple right now because it's not a saleable business. It's not a business people can even invest in. So the multiple of valuation is very low. So let's say 4 times earnings. If you multiply 4 times this, that's where you come up with roughly the 750,000 of value. So the company's valuation is, as we said, $750,000. The percent owned by the company owners is 100%, right? They own all. So the current owner's valuation is $750,000, but they right now can't get any cash out of the business, and so this number here is basically blank. All right. Now they're earning income. I don't want to confuse the fact that they have income and pays their rent and all that stuff for them personally. But this is what's left over when all that is about the business itself. All right. So what we would say to them, we're going to establish, for example, a milestone at 20 months out. Okay, so we're going to work with you 20 months out. We're going to have a milestone where we've agreed that milestone is the EBITDA of the company over that 20 months will be increased to 350,000. Now, before we've proposed that, we've analyzed their business enough to know how we're going to do these things here that will increase their EBITDA to 350,000. If we didn't have a way to do this, we wouldn't be offering this, because how are we going to hit this milestone? We know what sales we can add. We know some income sources we can add. We know through Scaleforce how we're going to reduce their costs. And we know from our management observations of the business how we're going to improve their cash flow. Okay, so we have a good sense of these things. So we're going to hit this milestone here of 350,000. And I know you have some questions about that, but let me get all the basic concepts out. So if we hit this milestone, the company is not going to be worth 4 times earnings anymore, because it has these things here now built into it. And because it's now got its growth going on here, you can now look at the company that's going to be more practically worth 6 times EBITDA. Okay. So the company valuation now is 6 times our milestone when we achieve it. So the company valuation is $2,100,000. And guess what? If it's not $2,100,000 because this happened, this didn't happen, then we don't have any shares. So they're right back here again, right? But they didn't give up anything because of what we did. We are now earning our way is now 2 million. So based on our achieving this, the percent owned by the current owners is now 70%, because we will have gotten 30% of the company because we did this. We built it to that. All right. Now what happens is 70% of 2,100,000 means that the current owner's share of that valuation is 1,470,000. So what that means is they've virtually doubled the value of their company, even though they now own 30% less of the company. As a percentage, they own double the company's value of what it was. Then we go out and go into the next milestone, which we would have, let's say, out at 40 months. Now, are all these months set in concrete? Is this the milestone, the only one that we would use? No, I'm giving you this as an example. And we did present this, by the way, and we did it very successfully. So I just wanted, this works. The income, the valuation for the 40th month is then based on a milestone of us bringing the company to 800,000 in earnings. And the price earnings multiple increases then, because not only do you have a growing company over this period of time, but you now have all of your standards in place. You have built by this time a team of people that are able to manage the company, that the owners in management are able to get all of the reporting and have all the scalable features built in so the company can continue its growth. So all that's done. So it's now a 7 times multiple. So you now have a company with a valuation in the 40th month of roughly 5,600,000. By that time, the 2 things have happened. When we get it to here, guess what this company is? It's financeable, right? It's got all of these things built in. It's got growth. It's got great records. You can authenticate the performance of the company. You can demonstrate its replicability and its growth capabilities. So now we're able to bring investment dollars into the company. So here is where we'll actually bring real cash into the company, because now the company is worthy of cash investment and cash loans. So we're going to have another event where the money that comes in is going to go cash to the owners of $2,240,000, but for which they give up another 40% of the company. So they end up with 30% of the company, and I'm sorry, they give up 30% more of the company out of their 7%. That still leaves them 40%. And they get cash out of $1,680,000. This is the amount of the cash that they get out. The difference between these two goes into the company itself. And again, it's hard to go through all of the nuances here, but I just want you to get the gist of it. So at the 40th month, they've taken a company that had a total value of $750,000. They've cashed out $2,240,000 that they now take to their personal bank. They still own 40% of the company, and the company now has another $1,680,000 of growth capital in the company. I'm sorry, that's the cash out amount to them. I'm crazy. The cash out amount to them was $1,680,000, and the company has retained the difference, about another $600,000 inside the company for additional working capital. So now everything is still working forward, but our 60-month objective or goal with them, or milestone, is basically to bring the profit of the company up to $1,500,000. So in 5 years, we've taken the company's net income up about 8 times in this process. So 8 times what it was in the beginning. But the miracle here is, once you're $1.5 million company and you've got all this working for you and you've got this kind of a track record, you now have a company that can sell at a high multiple of approximately 12. And especially if we are doing it with them, where our goal is to take that company and have it be absorbed into a public company. So that shares that they have left, this percentage that's still owned by them of this company, will get folded into a public company. So that's going to take it out of the realm of private company and put it into public company. We've positioned them, we've worked with them, we've nurtured them through our Buildup Buy-In to where this is now their performance. They're now valued at a 12 times multiple because we have them now as part of a company, of a public company. So the company valuation of the entity itself is now $18 million instead of the ways that it was valued here. And the percent owned by the shareholders is 20% at that time. And we get them another 20% of that cash out of $3,600,000. So what have they received of their, because they cash out at this point. So this 20 million is actually cashes out. So they're out of the company, they've exited in 5 years, and they've exited with $280,000 on our Buildup Buy-In, okay? And each year along the way, we also structured it in for, as we're growing, for them to increase their personal income. So this, starting with the 20th month, their personal income is going to go up 15%. By the 40th month, it'll be up 50% from whatever it is here. And by the time we've reached the 60th month, and this happens gradually all along the way, they're up to earning double or 100% more than what they were earning prior in terms of personal income. So it's designed to be win, and they haven't given up a share of stock unless we've produced these things, okay? And as we're producing these things, they're just getting wealthier and wealthier. Their business is more and more successful, or nothing is happening. Nobody's earning more. We go away because nothing's happening. And they're in the same position they were before if we didn't deliver, but they're never at risk for losing what they have, all right? So that's the way that the Buildup Buy-In basically is explained. All right, so what is happening here? Let's just talk about what's happening to this company, okay? We've transformed a business valued at $750,000 into $5 million cash to owners within 60 months. We do it with little or no risk to the owners, and it's consistent with their culture, traditions, and personal and family values, okay? So this is how we simply demonstrate this in the most simple and straightforward way, and that basically is the way it's done. Okay, now this company was basically increased sales to blank. Okay, so these were part of our goals for the company. So these were how we're going to set our milestones. Increase annual profit to X, increase annual EBITDA to whatever the agreement is, increase year-over-year growth rate to whatever that growth rate is, and create an ROI of whatever that percentage is to attract investors and raise X amount of working capital for the business. Now, we don't know for sure until we've done a final evaluation what these numbers are going to be. So that's why there's no numbers there. But this is part of the process, was what we will identify are the goals and the results that have to be achieved, and when they're achieved, they free up stock for us to receive our shares. And this is the model, okay? And also, I think you can see in this why it is that the owner of this company, who's struggled for years, knows that they've reached a peak and a plateau that they can't achieve more than in their business, to have a partner come in without having to give away any of the stock of the company until results are achieved, and then only based on the results. This becomes a very exciting option for that owner. And especially now, these owners were younger, okay, but they wanted to cash out and they wanted to do other things with their life besides the business that they were in here. So this presentation was based on a 60-month buildup, during which time at the end they would get out with that amount of money that we're showing there. All very attractive to them. But if you're a boomer and let's say you're 67 years old and you really want to retire, but it's clear that you haven't got the wherewithal in your company to do it, then this agreement with us is going to be very attractive, because there is no place else for them to go. There's no way they're going to get the money out of their business that they're looking for. And this offers them a real serious opportunity to do that with virtually little or no risk. And so that's why it's attractive. All right, the key elements of a build-up buy-in: it requires good record keeping and accounting. You can't set milestones unless you know when you've hit your milestone, right? In order to do that, you have to have good record keeping and accounting so that everything is trackable. You've got to be able to put in KPIs, key performance indicators, into your record keeping so that when your performance hits certain levels, you can see it in your KPIs. The KPIs tell you that. So you got to know how to put those into your reporting from your records, and the establishment of those and the ability to track those key performance indicators allows everybody to know where we stand relative to the growth of this company and the achievement of our milestones. And then the agreement on milestones and their equity value. So in other words, as we hit certain things, we're going to want a certain amount of equity in the company. That's going to mean that we have to all understand, as those milestones are added, what does that do to the value of the company, and how does that improve everyone's equity, so that everyone can make decisions that are reasonable and rational. Now, other key elements of the build-up buy-in are the methods that we're going to use for scaling the business for rapid growth, right? Ease of management, transferability of the business. Scaling requires development and implementation of standards, procedures, systems that, when followed, make the company manageable, forms that permit the systems to work, accurate, timely record and reporting. One of the problems we had with this company, it took us almost 7 months to get decent financial statements from them, because their methods of reporting were terrible. They didn't have any standards or systems in the company that would permit record keeping to be done effectively and efficiently or easily or timely. We had to help them put all that in. We did, and we can do it relatively quickly. It's a matter of literally taking a person who is going to have that responsibility, who has a minimal amount of experience and a certain education level, and then training them through videos on how to use the Scale4 system and to keep the records that they need to keep for the company. So all that can be done with us without a lot of time invested in the company, and that is very important, because if you have to invest a lot of time in this company and you're not going to get cash out of it until you meet your milestones, that's a problem. And by the way, some of the things that we do get money from the company, for example, if we add sales, we would get in effect like a commission, right? So the process of improving sales and adding new sales channels and revenue streams, that's commissionable, if you will. So we're going to start earning income from this company really within the first month or two, and at most 3. So it's not like we don't see any money till we achieve our milestones. There are certain things that bring in revenue, and we get a share of that. When we start getting financing for the company, there's the call it the brokerage fee, the finder's fee, the investment banking fee, call it what you want. But when you raise money comes in, a piece of that goes to the folks who raise the money. So a lot of the things that we do will be producing money. It's the milestones that produce our equity. Digitization of records and communication methods. A lot of times you go into these companies, whether they're foreign or whether they're here in the United States, they don't have they may have a PC, but it's not networked properly. They don't have the sophistication of technology that they need to really be a growing business. We will bring them all of that. It'll all be available to them. They are going to need some behavior modifications of employees and managers, because there's some disciplines that they're going to have to adopt here that when they were a fly by the seat of the pants company, they didn't have that. And that means some employees may have to go, and others are going to get elevated because they'll adapt and be performance people for the company. So we'll help them manage that process. We'll do it in a way that if their culture is one where the business is a family and they treat everybody really well, whether they're performing or not, that's an adjustment over time that will help them make. We'll be sensitive to their issues, but at the end of the day, it is a business, and they'll be the ones who will agree, yes, we do this and it's our value system, but we do have to make money here, and I do need to provide for my families in my retirement. So then the next steps are really pretty easy, okay? If they agree with the fact that this is a good thing for them, and by the way, I use a method of selling this that's I find very powerful. When I get to these different key points, as I've explained them to you, I use the sentence or the phrase, that makes sense, doesn't it? It makes sense to approach it this way, doesn't it? It makes sense when you're only giving up stock to get results. That makes sense, doesn't it? And when you do that, you're getting constant agreement with them all the way through, because everybody agrees it makes total sense. And so by the time we're finished with this, everybody's pretty much in alignment with the fact that this is a good thing for them to do to grow their business and then to exit with cash. Then we're going to want to develop a 5-year pro forma, because what we're going to look at in that pro forma are realistically, what are the elements we're going to be working on? How much are we going to change them by the efforts we're going to make and the opportunities we see, so that when we have the 5-year pro forma, that's going to be the basis under which we determine our milestones, right? What EBITDA are we going to have a year from now, 2 years from now, 3 years from now? How are we going to achieve that EBITDA? What are the things that are going to grow? What kind of income are they going to bring in? What are the costs going to be? As we reduce costs, what costs are real? How much do we think we can reduce them as a percentage of sales? So we go through all that until we develop a 5-year pro forma that we can all, them and us, can have confidence in, that this is the opportunity out there, that the methods that we're going to deploy to get there are reasonable, and that the goals that we've set and the pro forma that we've then established for those efforts are reasonable to achieve. Because once we've done that, any reservation that they had that this is a real deal, that we're going to be able to help them do it, those have all gone. Reservations are gone. They get it, that this is where this company can go, here's how it's going to get there, and everyone has confidence in the plan. Then we establish the major milestones, so that comes right out of the pro forma, and we establish the milestones a little lower than the pro forma actually would demonstrate, so we can have confidence that those milestones are reachable, they have confidence that those milestones are reachable, and we can all walk down the path together. And then the allocation of equity earned by achieving of the milestones. So what are reasonable multiples of EBITDA that the company should be worth having achieved those things? And again, it all gets backed right out of the major milestones that get backed out of the pro forma. All right, so that's it. Any questions? Any questions? Don't see any yet, but I know you're working on them. All right, I see one question finally got up there. Does the company pay for Salesforce services? Absolutely, okay? Absolutely. But look at it this way, okay? We're going to bring them tried, true, tested people and methods to get this done, either from our own group, our own staff, or from companies that we partner with. Remember, that's what Scaleforce does, right? We partner with companies. We have solution partners that are in every aspect of what it's going to take to build their business. So when we do that, yes, those are going to get paid for, but sales efforts are paid for literally as you go. A lot of them are going to be commissions, right? So the commissions only get paid from money that gets created for the company. So we don't have any problem usually with the Salesforce services. Those get paid for. People got to eat, just like they have to eat. The payoff is done from money that is generated in the company, which we can generate quickly. Remember, they've got product line, they've got all these things that they're doing. So when we are able to up their sales, that's rapid revenue generation, and that revenue is able to turn into income for everybody very quickly. All right, any other questions? Any other questions? Ooh, a bunch of questions. I'm loving it. Does it matter what type of business criteria? Oh, does it matter what type of business? And then the word criteria. No, it doesn't matter what type of business. Any business can be set up as a build-up buy-in. Any business. That's the beauty of it, is because let's say it has no assets in the business. Okay, it's a pure cash flow business. You already know no bank's going to loan them money, right? Because banks don't like cash flow companies, even though they love the cash flow. They want a secondary source of recovery of their money if the cash stops coming in. So the bank's not going to loan them money, and they don't have any assets to go to an asset-based lender, and no one's going to invest in the company for the same reason. What happens if all of a sudden sales just dry up? They stop. How do I recover my investment? So the build-up buy-in is literally the only way out for them. And at some point, they will become financeable. Why? Because their track record is deep enough, strong enough, long enough that a bank can have faith in the fact that they every year produce income. Now, the bank's not going to give them $1 bazillion in credit, but they'll give them some. Investors will give them some investment on the basis of the return on investment is worth the risk. In other words, if their growth rate is strong enough, then the increase in the valuation of their company will be rapid enough that the promise of money overcomes the fear of risk. Now, does that work for every investor? Of course not. But there are investors who, if the track record is good enough and strong enough, and the growth rate is long enough and good enough, that they will invest money in that company because the risk is worth the return that they get. Because you're able to show them, because of the growth of the company, where on their investment, they're going to earn 20% per year. They're going to earn 30% per year. Maybe we can double their money in a year because of the way we deploy their money. See, again, every business is different, so it gets analyzed differently. So you are always structuring your build-up buy-in for that second buyout. In other words, the first buyout is when you're buying in, but the second is where we're actually bringing money in the company, where either we or investors are buying shares, and the money's either coming into the company, but more of it's going to the selling shareholders, which are the guys who wanted to exit. But now that doesn't happen for a couple of years, remember? And that way we've now got people in place who can run that business without the owners, the former owners, being there running it every day. That's why we don't give them money up front, because we want to make sure they are tied into the business, because we've got a couple of years where we want them training everybody to do what it takes to actually run the core of that business. All right, and the next question here is, what are the guarantees that they won't jump ship? Okay, I almost covered that here. What kind of written agreement signed between them and us that is binding? They're going to get what's the equivalent of an employment contract with the company. We're going to, all of these, everything we are going to agree to is going to be in a written agreement. So all those agreements will exist. They can't jump ship the first couple of years because they're not getting anything. So if they jump ship, they're leaving us with a company that they can't get any money out of, at least at that point. So that's all built into the contract, and they aren't going to leave ship because they want their money. They get their money after that first round, and so that's what keeps them in the company. And by the way, okay, you have no guarantees in life about people or their character. Okay, you don't have that, but people do have a track record, and you follow up through due diligence on the track record of the people, not just the companies. Where have they worked? What have they done? What other businesses have they been in? Did they have other partners? How did they treat those other partners? Who were these partners? Can you set up a phone call so we can talk to them? There's lots of ways to do due diligence to find out if these folks are real, they honor their commitments. And in the world of social media, it's actually, if you're willing to do the elbow work, you're willing to put in elbow grease and to make the calls and do the follow-up, in today's world, you can find out a lot about people. Okay, you can find out a lot about them. We have them authorize a background check. Do they have a criminal record? These are all things we do as part of due diligence. Yeah, anybody can do anything, but if you've approached it right and you're willing to do the due diligence work, you can protect yourself from a lot of that. Okay, a lot of it. Everything? No. Okay, and people change, right? And most of the time, people stay the way they are, but people do change, and sometimes they've been run a good, clean life all their life. This time, things are just different for them, and they're going to do things they've never done before. That can happen. But if you're smart, you've protected yourself, and the agreement itself and the structure itself tends to protect everybody. Can you do this in all countries or just in European countries? No, we're doing this in South America right now. We're doing it in Australia right now. We're doing it in New Zealand right now. We have a company coming up in the UK, which we haven't presented this to yet, but we will. We're very comfortable. This is going to work everywhere. And there isn't any country that would have any laws or rules or regulations that prohibit this, except some countries have rules where in order to own a company that's a company of that country, you have to have somebody who's a citizen of the country own certain percentages of it. So it may be that these folks are our partners, and they may stay our partners for a long time into the future, but they become silent partners, and we adjust their compensation and all of that accordingly. We structure the buyout to accommodate the fact of the percentage that they have to remain owning. And then when the company is either part of a public company, when it goes public, when our company that owns that is taking a number of companies public, takes that into their company, then that usually solves the problem. And if the company ever has to be sold, then we're going to be looking for buyers within that country to take over their position, if that becomes an important thing to do. So there's lots of flexibility there. And the only thing that's ever been a problem with this type of thing is when a country has like Mexico has that. Okay, in order to own a company that is a Mexican company, 50% minimum has to be owned by somebody who's a Mexican national. That does happen. All right, very cool. Any more questions? I don't see any more up here. Any more questions? Come on, guys. Give me some questions here. All right, let me ask you a question. What do you think of this? Okay, can you see its value? Can you see yourself presenting this logic to a seller? Now, let's start with that, because anybody want to answer that question by raising your hand? So just raise your hand if you can see yourself doing that. You know where the hand raise is, right? It's on the side panel on the right side where you ask the questions. There's a hand above one of the columns. So next to your name in that column, you should be able to raise your hand. I don't see any hands raised. There's one. All right, we got one person who can see themselves too. Oh, come on, guys. I did a better job than that. I know I did. All right, only 2 hands raised. I've got 3. Thank you, thank you, thank you, thank you. All right, I'm feeling better now. All right, there's about another 12 or 14 or 15 people on here that didn't raise their hands. I guess I got work to do. All right, then let me ask you a question, okay? Come back in the question panel. Type in what it was that is between you and seeing yourself actually giving this presentation to a seller, all right? All right, so what's standing between you and giving this as a presentation to a seller, doing doing it with the idea of buying a business on a build-up buy? All right, here's a question. All right, well, all right, so a bunch of questions came in here. So now that I'm asking you questions, all right, yes and yes, it has an enormous value. Okay, I see that from Helmut, thank you. How do you open a discussion with a business for this matter? Okay, that's a great question. That's a great question. I don't propose a build-up buy-in for everybody, okay? I do it because the company is in a place where it's never going to max out its valuation until it has the things that a build-up buy-in can bring them. All the things that I showed you, we bring to the company. So I would start out in having this dialogue with a company where you start out in the normal way. We're interested in buying your company, okay? And the conversation starts to happen. You get their financial statements, and one of 2 things is going to happen, right? They're either going to give you financial statements right away because they got their act together, or it's going to take 3, 4, 5 months to get you the financial statements, or somewhere in between. So during that somewhere in between, the question is going to come up is, what is it going to take to get the financials? And that's the first clue that you have as to whether or not they even need a build-up buy. Okay, that's number 1. Number 2 is when you get the financial statements, or as you have an interview with the seller and they're telling you about their business, there's the 10 questions, right? Everybody should know the 10 questions that you're going to ask the seller. So as they're answering those questions, it becomes clear to you that the company is not scale for growth, that it's run by the seat of the pants, that if the owner left, the business has no value because, and this is true for anybody that wants to buy them out, by the way. If they buy them out and the owner leaves, everything's in the owner's head. All the relationships are in the owner's head. All of the buying sources are in the owner's head. All of the customers' relationships are probably with the owner. All those things are there, and you're going to know that by the questions that you're asking them. So at some point, it becomes clear to me that the business is not saleable, okay, in its present form, or it's saleable at such a low valuation that the owner can't get from it what he needs. So at that point is when I have a conversation with the seller, and I would tell him, John, I've been trying to look at buying this company. We like it. We like you. We'd love to do business with you here, but we've tried very hard to authenticate the valuation of the company, and here's the problems that we've had. And we see that the way that we can do this with you is through what we called a build-up buy-in, where we build your company up so that it's worth what you want to sell it for. Now, if we can build your company up, does that make sense to you as a way to get to where your company has value? And usually people will say yes, okay, because they know their problem. And at that point is when I start now to introduce them to the build-up buy-in and how we've made this work with companies in very similar positions to theirs. And here's how we can have you exit this company with the amount of money that you need in order to retire. And then I would show them something like I just showed you, where if I didn't have their numbers, I would use artificial numbers just to show them the concept, almost like I did here. And if we do have numbers, then I would show them that what their business is valued at currently. And I would say that I know that's not what you want to see as a valuation on your company, but these are the realities of the marketplace. But don't worry about that. We're going to help you fix it all. Okay? So then that's how I show them this. So hopefully that makes sense. My favorite statement, right? So hopefully that makes sense, or that makes sense, doesn't it? Could we get a copy of the slide deck? Yes, you can. What we'll do when we post this on the website, this webinar, we'll have as a download this particular presentation so that you can have it to replicate for yourself. And we'll do it on PowerPoint so that you can literally take the PowerPoint. We'll take our Bizar Financing logo out of the corner. You'll put your own logo in and totally customize this for yourself. You got to get rid of this guy smiling at you from the lower left-hand corner there. Your prospects won't probably appreciate him being there. But you'll be able to modify this for your own presentation. Gordon, could this work without using Scaleforce? The answer is yes, it could. But here's the challenge that you have, okay? You've got to have ways of reducing those costs. Who are you going to bring in to do that? How are you going to take and look at 27, 30 different cost areas in that company and optimize all of them. When it comes to bringing additional revenue sources to the company, how are you going to bring that? With Scaleforce, what you can do is you can aggregate this company into a strategic aggregation with other companies that serve the same clientele or the same type of clientele that they do. And we can automate them. You can automate them literally into a sales group where those sales are now happening automatic, where they're getting more value out of their customers as their customers are sold by the other strategically aggregated companies, and where we're bringing them more new business because the clients of those companies are getting cross-marketed to the company that we want to buy. We've got a platform that's all automated. It's going to be a lot easier with Scaleforce. Some of it, I don't think you can do it all without Scaleforce, like really aggregating companies, but some of it you can do. But there's no reason not to use Scaleforce. Scaleforce is free. Nobody pays to use Scaleforce. Every Scaleforce gets paid when it increases income, when it decreases costs, when it improves cash flow, when it brings in investment dollars. So why wouldn't you use Scaleforce to do it? And if you're not using Scaleforce or you're not familiar with Scaleforce, you need to write me an email, man, and I need to get you guys who want it familiar with how to use Scaleforce, because it's dynamite. It puts tools in your hands that enable you to do everything we're showing here and do it well. Okay, could you post some details where we can find out about Scaleforce, please? Yeah, first of all, there's a website that you can go to that was not written to sell Scaleforce. Okay, it was written with the idea of people ask questions, and so it's just loaded with facts, figures, methods, items that you would want to know about Scaleforce. But it's not designed to sell it. If you're going to sell it, you have a very simple site. You have pictures, all pictures, and you don't really answer anybody's question, but everybody gets excited about what it does, and so they sign up at least for a trial. We didn't do that. Okay, so what you're going to see there is explanations of what it does and how it does it. Probably more information than you really want to know. But anyway, what you do is you go to Scaleforce, Scaleforce at, Scaleforce.biz. .biz. It's not a .com, it's a .biz. All right, and yes, I'm having fun with bizes because it's my last name, Biz, right? Bizarre. So anyway, so just go to scaleforce.biz and you'll get answers to more questions than you're going to want to ask. Now, also, we have videos on National Diversify that go into Scaleforce, what it does, how it does it, goes through a demo. So here's what I'll do, okay? When we put the site up on the website, and we put this webinar up on the website, we'll make sure to give you links to all the places on National Diversified's site.com where we have those demos and all that stuff there. Okay, so we'll make sure you have an opportunity to get as familiar with Scaleforce as you need to. Okay, maybe you just hit a point. Perhaps several of us need more information on Scaleforce. All right, great. I think that's a really good answer. And then there's one other question on here. It says, just asking for those who didn't raise their hand. That's on. Oh, can you work without using Scaleforce? Okay, anyway, I appreciate all the questions. I really do. They're great. All right, it's the end of the hour, so we actually did pretty well. I got the questions answered that you asked. We got a whole bunch of questions that came in that were great, and I really appreciate those questions. So this is a time where I get to thank you for your enthusiastic participation here today. I really appreciate it, and we'll look forward to a great new year together in 2022, guys. If we really focus in on bizarre financing methods and techniques, it's going to be a fabulous year for everybody. So thank you for being here today, and we'll see you at the next one of these webinars.